I want to stick with this topic now and bring in Frances Donald. She is chief economist and head of macro strategy at Manulife. Frances, thanks so much for being with us this morning. You just heard Emily break down these numbers. As unbelievable as they are, Frances, do you believe that this number actually masks the true demand for unemployment benefits, given the fact that so many states are backlogged right now with applications?
Well, there's a lot of people who are going to look at this number and say, okay, it's declining, so the worst is behind us. We're actually probably saw most of these job losses were front loaded, but we still know that there are backlogs in the system. And more importantly, we have 26.5 million Americans who have had to file for initial jobless claims. And what worries me as an economist is that we can give people their jobs back when we turn the economy back on, not all of them, but some, but there is a confidence shock at play here. And are we going to be able to make these workers who've lost their job whole? Probably not. Even if we come out the other side very quickly, even if we have the so-called V-shaped recovery, we are dealing with a sizable confidence shock, a sizable financial hit that is not going to be easy to unwind. I think this is going to have a permanent stain on the way that Americans think, the way they behave, the way they save in the future. And that's why this V-shaped recovery probably doesn't make as much sense when we think about individual behaviors coming out the other side.
Frances, based on what you've seen from the initial claims data the past few weeks, what is that consistent with in terms of GDP growth this quarter?
We are going to see, without hyperbole, the worst economic contraction in modern economic history. It will be likely double digits. It will rival the worst GDP contraction we've ever seen in the 1950s, which was minus 10%. We could easily see something that is more like minus 20 or even larger than that. What I think is critical here is not so much the depth of this recession, which is going to be front loaded, it's going to be condensed. What typically we would experience over a 12-month period, we're going to experience within 2 to 3. But how do we reach out the other side? What does that reacceleration number look like? And here I think consensus is a little too optimistic. We are not looking for growth to come back online really until the fourth quarter of this year. Now, if you do want an optimistic story, we can stop thinking about the economy as a whole, what does aggregate GDP look like, and start thinking a little bit more about sectors. And if you do that, then, well, it's a lot easier to press a button and put a manufacturing plant back online. So you might see a V-shaped recovery in manufacturing and construction sectors. But for services, for confidence that flows through into the things that you and I buy on the day-to-day, that's going to take a lot longer. And the examples being set by those economies coming out of this first, like China, they prove that to be true.
Well, having said that, Frances, where and when do you think we're going to see a peak? Because remember, this time around, because of that stimulus package, a lot of people who couldn't apply for unemployment benefits and qualify now do, like gig workers, self-employed people. They're able to now apply. So when do you think we get a peak?
Well, most of the week-to-week data that we look at does tell us that the worst of the drawdown occurred about the middle of April. So if we look at steel production or mobility trends that Google produces, or any type of week-to-week data tells us that the worst of the declines probably ended in the middle of April. So I feel fairly confident that we can say that the drawdown on growth probably tapped out then. But that doesn't mean that we've hit a reacceleration button. It means that we probably will continue to see weakness on a week-to-week, month-to-month basis. It just won't be as strong as what we witnessed over the past 4 to 5 weeks. And that's what's going to be so difficult for markets to grapple with, is even though we've seen the worst of the drawdown, if we don't see a recovery, should we really be risk on? And that's the most critical market question facing us.
How, as an economist, Frances, what advice might you offer to the White House economic advisors as they try to map out what getting back to normal or some kind of normal looks like for American workers?
Well, we're trying to build a bridge from pre-COVID-19 to post-COVID-19 so that while our economies are in hibernation, while we've pressed pause, we're trying to limit the amount of defaults. We're trying to limit the amount of scarring on everyday households that comes through. And I think most governments have built a pretty strong bridge, but it's probably not a long enough bridge, because this is not an issue that's just going to be around for 2 to 3 months. We're still going to have scarring on this economy that persists for 1, 2, even longer. So as we think about policies, yes, we need to rescue immediately those that are struggling to feed their children, who need to be able to make rent. All of these month-to-month costs need to be covered, but we also need to be thinking about how long this is going to persist for and what type of economy we have on the other side. Because the problems we have today are very different problems that we're going to have in 6 months, and we should probably be prepared for the evolution of those concerns.
Francis, in your modeling, what type of economy do we have? To your point, the economy, because of the situation, has been scarred. What does growth look like the next 3 years?
Well, probably still looking at that 1% to 2% range. It's not very exciting. Where I get a little enthusiastic, and I know maybe this is too far out, but I'm looking for silver linings, is that if we do see large-scale infrastructure spending, if we do see productivity boosts, then we might actually be able to break out of this slow growth environment come 3-4 years from now. But the next couple of years are going to be marked by deflationary concerns, slow spending, high savings rate. There's really not a lot of ways we can get around that except to rely on the federal government, except to rely on state and local governments to try to provide a little bit of a boost as we get to this so-called other side.
Francis, in terms of like reasonably estimating the plunge in oil prices, when does the consumer go out there and start spending? Does the plunge in oil prices, what I'm trying to get at, does it matter? And if it does, when does it matter?
Oh, it matters. And it's really difficult, though, to find some upsides here, because typically what we say is that when oil prices tank, it's great for the consumer. You save money at the pump. Except that the American economy has made this transition. It is no longer the net importer it was in the past. So actually, when we see oil prices fall in the United States, we're now at the point where the benefits to the consumer are offset by the drop we see in investment, the drop we see in jobs in the shale patch. But moreover, nobody is going to the pump right now to recoup those benefits from lower oil prices. It doesn't matter if oil is at $30 or $15 because people are not consuming it, which is ultimately why oil prices are down. So the benefits that accrue to the consumer are just not happening right now. And I'm much more worried about the investment profile for the economy in the United States from lower oil, the deflationary impacts, and ultimately the message that oil is giving to us, which is this is the largest economic shock we've seen in modern history. And these commodities, any type of these goods that we're going to consume, the demand is going to be very, very low.
You know, Francis, a lot of people, I think, can wrap their heads around inflation. You said this is a very deflationary marker for us, the way oil prices have just cratered. Explain for viewers why deflation is a bad thing for the economy.
Well, it's not a bad thing in the day-to-day, but I'll give you the example. If you get coupons emailed to you for 30-40% off your favorite store, it makes you say, well, I'm not going to buy things at full price because I'll wait till I get that coupon, and it delays spending. So if people believe that actually prices are going to be falling over time, what we see is this very difficult circular loop where spending falls back as well. So a lot of central banks over time, many decades, have come to the conclusion that 2% inflation is what encourages the appropriate amount of spending. It means that we don't see overheating in the economy. I don't think central banks are going to panic if we see deflation for 2 to 3 months, but it makes it a lot harder to get back up to greater than 2% inflation, particularly if we're seeing deflationary impacts in services sectors and things like housing activity and restaurants. That was a segment of the economy that was holding up inflationary pressures closer to 2%. Those are now falling off to the wayside. So we should be prepared for some negative month-over-month inflation data. In the near term, does it bother me? Not too much, because I do think that government spending will come in and create some offsetting pressures, but you are going to hear a lot of people talk about deflation, and to your point, whether or not it's a good thing or a bad thing.
Yeah, Francis Donald, great insights this morning, chief economist and head of macro strategy at Manulife. Thanks and be well.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.